Welcome back. We're now going to review types of life insurance. By the end of this lesson, you should be able to discuss the different types of life insurance, including term, whole life, endowment life, variable life, universal life, variable universal life, joint life, and return of premium term. Some characteristics of life insurance. The policy is a valued policy. The insured and the insurer agree in advance to how much the loss is worth. That's the face amount of coverage in the contract. Since death is a certainty, the insured event is the uncertainty of the timing of the death. And also a full loss. There's no possibility of a partial loss, as in the case of the casualty insurance. You're either dead or you're living. There's no indeterminate state. Life insurance is not a contract of indemnity. In prior lectures, we talked about the principle of indemnity and how life insurance is one of the exceptions. Again, the slide here talking about, unlike casualty insurance, which attempts to put the insured back in the same place, this cannot be done with a human life. The insurable interest requirement is much more relaxed in life insurance than in other types of insurance. Again, reviewing. In property casualty, you must possess an insurable interest at the time of loss. In life insurance, you only have to demonstrate an insurable interest at the point of application. And now all life policies can be classified into one of two categories, the first being term and the next being cash value life. Term insurance provides pure life insurance protection for a definite period of time. Cash value life coverage provides permanent life insurance protection that builds up a savings element over time. So on the left we have term, on the right we have cash value, whole life, endowment, universal, adjustable life, and variable life. And in the middle column, we actually have a hybrid, return of premium term coverage. So in simplest form, term life, yearly annual term, is a renewable term life policy that provides protection for a one-year period, but permits the insured to renew the policy for successive years without evidence of insurability. So the cost goes up every year, but the coverage is still in force, subject to the condition of the insured paying the premium. Some other features: it provides protection for a temporary period. Typically 1 to 30 years or age 65 is very common with most carriers. It's usually renewable, that is, it can be renewed to a specified age without evidence of insurability. So you might see term to age 95 or term to age 70. It's usually convertible, meaning that it can be converted to a permanent policy at any point in the future without evidence of insurability. Now, some insurers will have a time limit, some will not. It just depends. Look at the contract and the provisions of it. And term usually has no cash value or savings element. It's just pure coverage, as stated before. Some features of term insurance: long-term policies develop a very small reserve, which is depleted by the policy expiration date. So again, there's no cash value in it, but a reserve may develop. The net premium is determined by the death rate for the age group of the individual involved. And since the death rate for an age group increases as the group ages, the net premium for the group increases each year. Here's an example of that. You can see the net premiums relative to age. In the early years, the premium is very inexpensive, but as the frequency of death occurs with the onset of aging, you could see it goes up substantially. Let's talk about some cash value life insurance. It provides both life insurance protection and a savings element. Cash value life insurance premiums are sufficient to cover the insurer's mortality costs and expenses and builds up a savings fund within the policy. Typically, those funds grow tax deferred, and if they're accessed in the future, they can come out tax-free if there's been no demonstrated gain in the policy, and the life insurance company will tell you if there is a gain or not. Cash value life insurance has evolved over the years into a bunch of different products. We started with whole life coverage, ordinary life, limited payment life, and current assumption whole life. Then endowment life was created to endow at a specific age, whether the insured is living or dead. Well, of course, if they're dead, it's going to pay off ahead of time at the point of death. Variable life, universal life, and variable universal life. And other would be joint life. You'll hear a second to die or third to die policy, typically used in large estates. Now, term versus whole life. In contrast with term insurance, it's going to pay only if the insured dies during the period where the insurance is in force. Whole life coverage provides payment for the policy's face amount upon the death of the insured, regardless of when the death occurs. The other type, going back a few slides where we had term on the left and whole or permanent cash value on the right, the middle, the hybrid, is return of premium. It has features of term and is funded underlying by term, but has a guaranteed cash value at the end of the stated period. Typically on ROP, or return of premium, 20 and 30 years are the common terms. The rate for return of premium a few years ago was running roughly double that of term. Now, in a very low interest rate environment, that the rate has gone up accordingly as the interest rates that the insurance company can earn have gone down. Whole life, providing lifetime protection to some maturity age, usually 100. Premiums are level and do not increase with age. And cash value, the savings element, increases over time and generally equals the face amount of the policy at age 100. Policies are issued on either a participating or non-participating basis. Participating policies return part of the premium as a dividend. That dividend is based upon the profitability of the insurer, their expenses, their actual mortality experience at the end of the year, so the dividends can vary. Non-participating policies do not pay any policy owner dividends. Most whole life policies are level premium, meaning you're going to pay the same rate. If you take that policy out at 35, you're going to pay that same rate your entire life, no matter how long you live. So again, this means the premiums do not increase from year to year, but remain constant. And this feature is possible because the excess premiums that are paid in the early years of the policy are invested and can compound, using to support the deficiency in premium during the later years. So again, you can see here the comparison of net premium per $1,000 of insurance. On term insurance, it advances as we've seen before, but with whole life, it stays level. And within whole life, some types of policies. We have ordinary life and limited payment life. Ordinary life is what we've been talking about up to this point, traditional whole life insurance. Limited pay would be, you'll see some companies do a 10 pay, where they have 10 annual payments, or a 15 pay, 20 pay, 20 years annual payments. So some characteristics of traditional whole life, ordinary life insurance. We've already gone over level premiums a few times, and is usually the lowest cost of all whole life products because the premiums are stretched out over the estimated lifetime of the policyholder. They also usually produce lower cash values than other whole life policies because less money's going in. The old saying, it takes money to make money. I've seen some companies where ordinary whole life has been fairly expensive, but the cash values have significantly accelerated 20, 25, 30 years down the line, and other companies' policies where the whole life policy is relatively cheap, but the cash value just inches along ever so slowly. And let's see here. So yeah, and the final bullet point, usually it produces maximum amount of insurance protection per dollar of premium outlay. Again, that's traditional ordinary whole life. Now the limited pay whole life, level premiums are paid for a certain period, 10, 15, 20 years. Then the policy is paid up. Paid up meaning the future dividends off that policy will be sufficient to cover the cost of insurance in the future. The premiums and cash values are higher than those for ordinary life, and the cost of pure insurance protection is higher per dollar of premium outlay. Endowment life provides level death benefits and cash values that increase with duration, and the policy's cash value equals the death benefit at maturity, but also allow the purchaser to specify the policy's maturity date, so they could choose that point in the future when they want this to endow or mature. So it's similar to term insurance in that it pays the face amount of the policy if the insured dies during the term, and they pay the face amount of the policy at the end of the policy, even if the insured is still living. So again, more characteristics of endowment life. It pays the face amount. Premiums and cash values are higher than under traditional ordinary whole life policies. And very few endowment policies are sold today because they no longer meet the definition of life insurance under the tax law. There'll be what's called a modified investment contract, and the proceeds may be subject to taxation, and the living benefits that will most likely be subject to taxation. At that point, defer the client to their tax professional for the details of how it will impact them specifically. An example of endowment life: a 31-year-old female purchases a 20-year, $200,000 endowment life contract. If Louise were to die during the next 20 years, it would pay the face amount of the policy. If the client was still living in 20 years, the insured would pay the face amount of the policy to her. So, other forms of life insurance. The life insurance that we've discussed up to this point represent all the traditional forms. Numerous variations of these traditional forms have been developed over the years. We have return of premium term, current assumption whole life, variable, universal, variable universal, and joint life. Return of premium term. Some people mistakenly think it's a skinny universal life. Low period, it gives you a stated dollar amount at the end of that guaranteed period. So that period of 20 or 30 years. If that were the case, it would not be tax-free. Return of premium is tax-free at the end of that period because it's returning the premium. And the premiums were paid post-tax dollars, so therefore, when they're returned, they are not taxable. And that's what we've gone over in the 2 bullet points here. It is not permanent insurance. It is a term policy that returns the premium back. The cost of term coverage after the premium is returned will be very high, and most clients will drop the policy. This is a relatively new policy in the insurance marketplace. Most carriers have been doing this for less than 10 years, so we haven't seen the payoff happen from these yet. I have seen clients with this policy, and they're waiting for that event to occur. They want to be healthy, and they want to check. So the last bullet point there, the planner should check the illustration, as there should be an internal rate of return listed on the illustration, so the client can make a decision on a regular term policy and buying term and investing the difference, or if the return of premium makes better sense. Current assumption whole life coverage. The policy's premium varies with changes in the insurance actual or anticipated mortality, the number of people dying, and the interest earnings experience. Premiums are added to the policyholder's accumulation account, from which a mortality charge and expenses are deducted annually. Interest is also credited to that account. The cash surrender value of the policy at any time is equal to the accumulation account minus the surrender charge. Some more characteristics of current assumption life. Usually non-participating, but favorable experience may reduce or eliminate those premium charges in the future. There are guaranteed maximum premiums based upon maximum mortality and expense charges and minimum interest rate credit. So there is a ceiling on this of what could be charged. And the premium must be paid when due, or the policy will lapse. Additional characteristics: low premium design. Premiums redetermined periodically as conditions warrant. And the high premium design, policy may reach paid up status for a time, perhaps even permanently. Usually a guaranteed interest rate and current interest rate are used to determine the cash values. If on a redetermination date the premium changes up or down, the policy owner has the option of paying the new premium and keeping the death benefit unchanged, or paying the old premium and accept a change, which will typically be less, but it could be up, in the death benefit or increase in the accumulation account. Variable life insurance. The cash is kept in a separate account, so the death benefit and cash surrender values vary according to the investment experience of a separate account maintained by the insurer. Investment decisions. The insured has the right to direct how the policy's cash value will be invested. Typically, it's in mutual funds. So you'll see large cap, small cap, blends, bond funds, international equity, international index. There'll be a large palette of funds that they can either choose the insurer's allocation based upon their risk tolerance, or they can create their own portfolio. And now the insured bears the investment risk in the form of fluctuations in the cash value and death benefit. Again, more characteristics. The policy is a permanent whole life contract with a fixed premium, and the entire reserve is held in a separate account and is invested in equities or other investments. As stated previously, the policy owner can create the mix that they'd like, or they can accept a predetermined allocation that the insurance company has come up with. Now, if the investment experience is favorable, let's say we're in a appreciating stock market environment, the face amount of the insurance is increased. If the investment experience is poor, the amount of insurance is reduced, but can never fall below the original face amount. Additionally, cash surrender values are not guaranteed, and there's no minimum guaranteed cash values. So again, let's step back a second. On whole life, the investment risk is borne solely by the insurance company. They have guaranteed minimums in that policy. On variable life, there's a potential for higher return, but there's also potential for loss because the investment risk has been shifted from the insurance company to the client. And continuing on the slide here, guaranteed minimum death benefit equal the policy's original face amount. Above that minimum, the death benefit depends on the investment results, and typically policy loans are allowed. But a note on policy loans of variable life. Because of the uncertainty of market fluctuations, if a policy, let's say, has $10,000 current account in the separate account, current account value, that the insurance company typically limits the loan to 90% of that value, and the amount that's being borrowed against is shifted over to the fixed account. So the insured has a much more predictable path as far as how that reserve is going to behave. It may be sold only with a prospectus, and the agents who sell variable life contracts must be licensed securities agents as well as insurance agents. So the agent must have a Series 6 or Series 7. Now, universal life. The technical name for universal life is flexible premium whole life insurance. So it's a flexible premium policy. It provides lifetime protection under the contract that unbundles the protections and savings components. The policy owner determines the amount and frequency of the premium payments. So the premiums less an explicit expense charge, let's say $7 a month plus a percentage, is credited to the cash value account from which a mortality charge is deducted and interest is credited based on current rates. These policies are also subject to a charge for administrative fees. So again, all these expenses have been unbundled compared to ordinary whole life. So, and as the slide states, unbundling in 3 component parts: the protection component, the savings component, and the expense component. And the components are reported annually to the policy owner. It'll be an annual policy statement saying, here's the cost of insurance, here's the expenses, here's what you put in, here's the increase in the cash, and here's the interest rate credited on the prior cash. So there are 2 forms of universal life. You'll see option A or option B. Some companies you'll see option 1 or option 2, but it's all the same. Option A or option 1 would be a level death benefit. So it behaves a lot like a traditional ordinary whole life policy in terms of the death benefit. Cash values build up and less insurance is purchased to keep that death benefit level. Option B, you'll always have a constant amount of insurance going along. Let's say it's $200,000. And any cash value will stack on top of that. So years down the line, you will get the $200,000 of coverage plus whatever the account value is at that point in the future. And there's considerable flexibility compared to whole life. If an ordinary whole life insurance policy says the premium is $80 a month, that premium will always be $80 a month, and it is always due. It'll either be paid by the client or by the cash values inside of the policy. Now, on universal life, it's a little bit different. You can hit the pause button, so to speak. Premiums can be increased or decreased, and the frequency of payments can be varied. However, clients who abuse this privilege typically will end up in financial trouble, and the policies will collapse for being underfunded. Second bullet point. Premium payments can be any amount as long as there's sufficient cash value to cover the mortality costs and expenses, and the death benefit can be increased with evidence of insurability or decreased. So if someone takes out a policy and they want to increase their death benefit in the future, they still have one policy, one set of policy expenses. On ordinary whole life, in contrast, they can't just add to the policy. They'll keep that policy and they'll buy a second policy, and each policy has inherent costs within. So again, there's pros and cons with universal life. And the policy can be changed from option A to option B, and vice versa. And partial cash withdrawals can be made without terminating the policy. So again, on universal life, we can do a withdrawal. On whole life, we cannot do a withdrawal. We can take out dividends, but the cash value inside can only be accessed via death or surrender. Well, let me step back 1 second on that one. There can be loans against either type of policy, but pure withdrawals can only happen from universal life. We just gone over this. Cash withdrawal is permitted and enjoys the same favorable income tax treatment as traditional cash value life policies. So again, universal and variable policies, we have flexible premiums as a feature. From that, what else is added is the interest from earnings or investments, and then taken away from that cash value is the monthly administrative charge, monthly cost of life insurance, and any withdrawal or termination service fees if the borrower is paying interest on a loan or any surrender charges if the policy is surrendered. Variable universal life is a policy that combines the flexible premium features of universal life policies with the policy owner directed investment features of a variable life policy. The policy adopts the same death benefit design applicable to universal life. So again, that option A, option B, or option 1, option 2. Some other characteristics of variable universal life. Premium flexibility, so similar to traditional universal life. Death benefit design flexibility, investment flexibility, and again, agents who sell variable life insurance must be licensed as securities, either Series 6 or Series 7, as well as insurance agents. And again, a prospectus is needed to sell the product, and cash withdrawals are permitted. So this table, this matrix, is a comparison of life policies between whole, universal, variable, and variable universal. So you can see, again, the premium amount, the death benefit, policy owner control over investments, and return on those investments. You might want to hit the pause button on your player right now just to look at that table a little longer, and then continue on. Joint life. Joint life insurance is a policy that's written on the lives of 2 or more people. 2 types, typically first to die policies, payable on the death of the first person to die, and second to die policies, payable on the death of the second person to die. Both types are usually some form of cash value insurance and are popular for funding various buy-sell agreements. They're also used, the second to die policy, you will see in large estates where that policy is put into an ILIT, an irrevocable life insurance trust, the proceeds of which are used to pay the estimated estate taxes, so the estate can pass intact and not forced to be broken up and sold at discounted prices. So in summary, we've reviewed various types of life coverage: term, ordinary whole life, endowment life, variable, universal, variable universal life, joint life, and last, return of premium term. Thanks as always for your time.